Of course, compared to gold, gold started breaking out, I think February last year. We broke through that 2100 barrier in gold, and here we are almost at 3000. So I think it's going to take a little longer here for the CRB to actually break the June 22 high, which was 330 or thereabouts. But I think we're going to have a major leg up, and I think we're just beginning this secular bull market in commodities, and this is not going to be. It's going to be protracted. It's secular, and I think what it means, along with gold and silver moving higher, is that our currencies, our fiat currencies, are actually. They're beginning to show what they're really worth after years of central banking inflation.
Gold broke through the $2,100 level last year and is now nearing $3,000, signaling a strong breakout. While the broader commodity index, CRB, has yet to surpass its June 2022 high of 330, a significant upward move is expected. This marks the beginning of a long-term secular bull market in commodities. As gold and silver rise, fiat currencies reveal their value after years of central bank-driven inflation. Mario Innecco, a financial analyst and commentator, recalls that in early 2020, markets across the board experienced a sharp crash, with stocks, gold, silver, and commodities all plunging. Even U.S. Treasuries, typically considered a haven, were highly volatile, prompting the Federal Reserve to use quantitative easing, QE, to stabilize the bond market. Gold initially dropped from $1,750 to $1,450 but quickly rebounded, reaching nearly $2,000 by mid-2020. Commodities, however, lagged, only peaking in June 2022. Mario explains that, over the past 2.5 years, commodities have been consolidating, forming a pattern that often leads to a bullish breakout. Gold began its breakout last year, surpassing the $2,100 level and nearing $3,000 today. While the CRB index has yet to exceed its 2022 peak, it is on the verge of a significant upward move. This signals a shift towards hard assets like commodities, gold, and silver, as fiat currencies weaken due to years of central bank-driven inflation and excessive government debt. Stocks and bonds may not disappear, but they will likely underperform significantly in this new era of tangible assets. Before we dive into the video, subscribe and turn on the bell icon so you never miss our latest updates. We'd love to hear your thoughts, so drop a comment below.
Back to commodities and gold. And back in 2020, we saw everything really crash. That was from January to like April of 2020. The stock market, gold, silver, the CRB index. Bonds, of course, were very volatile. They were up and down like a yo-yo, which isn't good either, because treasuries specifically are supposed to be, as good. Well, not as good as gold, but they're supposed to be very stable and risk-free. And they were anything but. And that's one of the reasons why Jay Powell had to start QE to stabilize the treasury market. But one thing that happened is that gold dropped from 1750 to 1450. It was very quick, and then it took off. And by by July or by the summer of 2020, the same year, gold was back towards 2000. While commodities lagged, and commodities only topped in June of 2022. So gold and silver, to some extent, led the way. And then commodities followed. But for the last, let's say 2.5 years or so, commodities have been consolidating in this pennant formation. As you can see here, this is the CRB index. It's a Commodities Research Bureau index. It's a collection of major commodities. It includes gold and silver as well. And I've been talking about this for the last few months, that it looked like we're going to break out of this consolidation. And usually these consolidations after a major leg up, they can either be, well, they can be 75% of the time very bullish, or 3 out of 4. Sometimes they fail and the market goes back down. And I think it's definitely breaking out here. And it's a little bit delayed, of course, compared to gold. Gold started breaking out, I think, February last year. We broke through that 2100 barrier in gold, and here we are almost at 3,000. So I think it's going to take a little longer here for the CRB to actually break the June 22 high, which was 330 or thereabouts. But I think we're going to have a major leg up, and I think we're just beginning this secular bull market in commodities, and this is not going to be, it's going to be protracted. It's secular, and I think what it means, along with gold and silver moving higher, is that our currencies, our fiat currencies, are actually they're beginning to show what they're really worth after years of central banking inflation. And by inflation, I mean all the money printing and also the fiscal loose fiscal policy of the major countries. We're up to here in public debt. This is how the system rebalances itself. I think we are in the age of hard assets and tangible goods, commodities. It doesn't mean to say that stocks and bonds are going to disappear, but they're just going to underperform massively, and there's still not that much money in commodities, gold or silver or any of these sectors.
Mario highlights that the financial system has been heavily inflated, with an overvalued stock and bond market creating a massive bubble. Even a tiny capital shift into commodities could trigger significant outperformance. Jim Sinclair's insights in A Pocketbook of Gold highlight gold's role as a revealer of falsely stated wealth. When expectations of wealth are unrealistic and fiat currencies depreciate, the public bears the burden through lower living standards and economic instability. This is becoming evident today as inflation erodes purchasing power, and financial mismanagement at both personal and governmental levels worsens the situation. As military and financial overreach strain national budgets, social programs like Medicare and Social Security become unsustainable. In an attempt to maintain control, governments continue making promises of wealth that do not materialize. Real estate, once considered a guaranteed path to riches, is proving to be a myth when measured against gold. Historical data, such as the UK's house price to gold ratio, shows that property values have stagnated. Meanwhile, the purchasing power of fiat currencies continues to decline, exposing the illusion of prosperity that many once took for granted. Now let's jump into the interview.
There's been such a huge bubble created in the paper market, in the 60-40 stocks and bonds, that even a small percentage of the money flowing to commodities is going to make it a huge, relatively speaking, outperforming market to stocks and bonds. And I told you in the beginning that I'd tell you what this means, this breakout in commodities, and that I'm going to refer to A Pocketbook of Gold by Jim Sinclair. He wrote it along with someone called Peter Carlin. And unfortunately, Jim Sinclair passed away, I think it was last year. And Jim Sinclair, I started following him in 2002 when I started buying gold and looking into gold. He had a great blog called JS Mindset, so I have a lot to thank Jim Sinclair for, and it's a shame he's not here to see this bull market in gold, but he did see the one in the 70s though. Anyway, I want to talk about gold is a revealer of falsely stated wealth. It's on page 70, as you can see here. And it's tough to get this book, unfortunately. Someone asked me if I could copy it and put it in a PDF file, but that's not something that I do. This is copyright. You're just gonna have to search for it, and it's not gonna be cheap, unfortunately. So gold, let's see what gold really tells us, and commodities as well for that matter. When wealth is overstated and expectations for future wealth are unrealistic, fiat currencies depreciate. Well, that's what we're seeing now. I think the jig is up for the falsely stated wealth camp. The depreciation is borne by the citizenry who are forced to lower their living standards to compensate for both personal economic mismanagement, well, taking on too much debt, not stacking enough, as well as the mismanagement of the affairs of state. Well, they're trying to fix that, but I think it's a little bit too late. Anyway, financial and military overextension has a social corollary in overpromised Social Security, Medicare, overstated real estate, equities, affluence. As expense runs out of control, guarantees to the citizenry also explode as politicians seek to retain the privilege of office. But the promises of wealth are false. The belief that ownership of real estate is a ticket to fortunes is hollowed out for what it is, a myth. And before I continue, just wanted to show you the chart of UK nationwide house price index to gold ratio. And notice how the top of that ratio was in 2004. So that's when houses were the most overvalued versus gold. And you can see that versus gold, UK house prices actually have not done well. Gold is a revealer of falsely stated wealth. So let's continue. Wealth that was taken for granted suddenly appears ephemeral. The amount of currency which once bought certain things no longer does, but wages have not risen along with prices. Well, we're seeing examples of the currency not buying what it used to.
The current economic landscape is shifting as inflation, excessive government debt, and central bank policies continue to weaken fiat currencies. Gold and commodities are emerging as reliable stores of value, revealing the fragility of falsely inflated assets. As markets move toward tangible assets, stocks and bonds may struggle to keep up, marking a turning point in the financial system. Investors must consider the long-term implications of this trend and adapt accordingly. How might continued inflation impact consumer confidence and investment strategies in the coming years? What role could central banks play in stabilizing fiat currencies amid rising demand for gold and commodities? Be part of the discussion. Share your thoughts in the comments, like this video if you found it helpful, and subscribe to stay connected with our community.